You probably learned this story back in school. One person has chickens, the other has shoes, so they trade. Eventually, someone tires of hauling chickens, and coins appear. Clean logic, except historians can't find evidence it ever happened. Anthropologists spent decades hunting for a society built on pure barter. They haven't found a single one. Not in ancient Mesopotamia, medieval Europe, or the pre-colonial Americas. What they find, going back 5,000 years, are records of debt. Grain owed, labor promised, obligations pressed into clay. People weren't swapping objects, they were tracking what they owed each other. So if barter didn't give birth to money, what actually did? That answer changes how you see banks, debt, and inflation. Before coins, before paper, before banks, villages ran on memory. Your neighbor fixed your roof, and you owed him something back. That wasn't barter, it was credit running inside people's heads. That system breaks the moment community grows too big to remember. So humans invented a token, portable, scarce, and universally accepted. With a coin, you could settle a debt where nobody knew you. Money turned a personal favor into something a stranger would honor. From that one invention, money took on 3 distinct jobs. It pays a debt, prices everything, and stores value for later. The token doesn't need to be precious, it needs to be trusted. Trust is the actual substance of money, not the coin or paper. Money began as memory, and trust is what still makes it work. From gold to government promises, how money stopped pointing to something real. For most of human history, money had to earn trust the hard way. Gold and silver worked because the metal was scarce. You could not simply make more. They were hard to fake. Merchants would literally bite a coin to check it. Then came paper. Early banknotes were just receipts, a promise of gold in a vault. People passed the receipts around instead of hauling heavy metal. Easier, faster. The receipt became money, but it still pointed to something real sitting in a vault. That link did not last. Through the 20th century, country after country severed the link between currency and gold. The United States made it official in August 1971. Nixon closed the gold window. No more exchanges, no vault behind the dollar. So what backs a dollar today? The belief that others will accept it. That sounds thin, but collective trust across an entire economy is remarkably durable. Money stopped being a receipt for something real. It became the thing itself. Chapter 4. Banks don't lend your savings. We picture Anna depositing, Ben borrowing, the bank just a middleman. That picture is wrong, not a little wrong, fundamentally wrong. The bank doesn't touch Anna's money. It opens Ben's account and types a number. That money did not exist 1 second before the loan was approved. Banks create money by lending. The deposit comes after the loan, not before. Today, roughly 95% of money is digital deposits, not printed cash. So why doesn't this just spiral into infinite money? When Ben repays, those digits vanish. The money is destroyed, roughly in balance. Central banks raise rates. Borrowing gets pricey. Fewer loans, less new money. Anna's deposit still matters. It gives the bank stability and trust. Ben's money came from a ledger entry. That's how most money is made. Why your money buys less each year. In 1970, $1 bought roughly what $8 buys today. That is not a rounding error. That is 50 years of inflation working. More money chases the same goods, so each dollar competes harder. Prices rise, and each dollar claims a smaller slice of everything. Central banks, like the Federal Reserve, actually aim for about 2%. At that pace, prices drift up, wages follow, and life keeps moving. The danger is when 2% becomes 20, or even 200. That happens when people stop trusting the money itself. In Germany, in 1923, prices were doubling every few days at the worst. Workers were paid twice daily to spend before the money lost value. That is not economics misbehaving. The shared agreement is breaking down. A little inflation is the price of growth. Runaway inflation means trust is gone. In 1930, one New York bank's quiet promise was about to be tested. the Bank of the United States held nearly 500,000 depositors. A rumor started, nothing verified, just word the bank might be in trouble. Depositors lined up. By opening time, thousands were waiting on the sidewalk. The money existed in every accounting sense. It just wasn't there in cash. You deposit $1. The bank keeps a fraction and loans the rest out. It works perfectly until everyone wants their dollar back at the same moment. The bank closed that December, one of the largest failures in American history. The loans were still on the books. What broke was the belief. The money was real as long as people treated it as real. Every loan rests on a quiet agreement. Everyone keeps trusting. No one flinches. A panic destroys money the same way it was made, all at once, through shared belief. Chapter 7. It was always about trust. 6,000 years ago, a scratch and clay became money. The agreement, not the clay. Goldsmiths issued paper receipts for vaulted gold. The receipt became the money. A bank approves your loan. No vault opens. A number appears, new money. Clay to parchment to paper to pixels. The medium changed every time. Money is a shared promise. When enough believe it works, when belief cracks, it stops. Money has no value of its own. Its value is borrowed entirely from collective agreement. Inflation is when the supply of promises outgrows the things they can buy. Bank run is not panic. It is the rational response to doubting the promise. A digital coin or a central bank experiment asks the same old question. Can we trust this? Watch where the trust is. Watch what could break it. That is the whole game.